Hi everyone, Rosa here at CreditXpert. I hope this finds you safe at home like all of us at CreditXpert currently are. One of the things we've heard from a lot of you is just over the past few days, among other things going on in the world, a lot of the lenders have systematically raised their scoring requirements for federally insured loans. So you have people in your pipeline who maybe needed a 620, now they need a 640 or a 660. And a colleague reached out to me and said, what can we do to help them? And my immediate response was, if I were in their shoes, I would systematically focus on external collection company accounts instead of reducing revolving debt. And I mention this because in a lot of cases, it requires a much smaller payment to provide improvement when they do have these third-party collections. And it's going to provide a bigger boost, meaning if they're currently sitting at a 590 or 600 and all you needed to do historically was get them over a 620, in a lot of cases just a small revolving debt reduction would take care of that for you. And the borrower was able to carry that out. However, moving them from those type of numbers up to a 640 or a 660 is a much different case, requires a very large debt reduction if it can be done at all. So I just wanted to share with you a little bit about third-party collection accounts and see if this might help you right now based on what's currently going on in the industry. So in this particular example I'm about to show you is a borrower who's currently sitting at a 611, right? And historically you need to get them above a 620. But now we need to get them, let's use the example of up over 660. And you can see they have quite a bit of substantial amount of revolving debt. And in the past, you may have tried paying off those accounts. And as you can see, to move the needle enough to get them to where we need to be, they're now going to be at a 669. However, they need to come up with $51,000. And let's face it, that's just not reasonable in most situations, if I dare to say nearly all situations. The one thing that I see on this file is that they have an external third-party collection company account. Now that's different than a first party, and I need to clarify the difference between those two because the credit scoring model treats them very differently. So if people are trying to give you advice about credit scores, and they're talking about collection accounts in general, and they're not differentiating between the two, you really need to be skeptical about the information you're hearing. So in this case, when I say third party, I'm talking about a record that's being generated and reported to the credit bureau due to a collection company reporting that information. So that's much different than, say, maybe the Barclays account or the Kohl's account going late and getting a status of in collections, right? That's still a revolving account in collections, so that's a first party collection company account. This, however, is a collection, the type of collection, it's a third party collection company account. In this particular example, since there's no name reported, likely due to HIPAA, I assume this is a medical collection. So what's going on with medical collections or any type of third-party collection? From the scoring model perspective, what matters is that they exist and when they occurred. So this one is pretty recent, right? Within the last year. So we know it's probably having a pretty significant impact. Paying this collection company off is not going to do a thing. Now, we've had a lot of feedback from clients saying, I don't think your software is working. I paid off all of their collections and I didn't get any improvement. Well, they were talking about third party, and paying them off is never going to help in a third party collection. If the score sees it as a third party collection, again, the only thing that matters is when it occurred and the fact that it exists. Now, current scoring models that are used in other industries like FICO 9, they systematically, when that account is paid off in the FICO 9 model, a collection company account is paid off, it's no longer considered in the score. But those scoring models that are still in use in the mortgage industry are quite dated, right? They go back as far as 1999 in one of the bureaus. So they don't treat them that way. But what you can do is work on getting that collection removed from the credit report. And again, paying it off, no benefit. We can simulate the removal of the collection when you hover over the account, click on the red X. Now, if that collection were to be removed, we're looking at an improvement to 668. So to make that happen, it may be a matter of the borrower reaching out to the collection company and asking for them to remove the record in exchange for settlement. So the collection company wants to get paid. And in most cases, medical collections especially, that your borrower may not even know that this is being reported on their credit report. So it's a valid collection, right? They owe the money. Sometimes they'll settle for 25 cents on the dollar, 50 cents on the dollar, and in this case, it's a $188 collection, even if they need to pay it in full. The key is to get the agreement from the collection company stating they're going to remove the record in exchange for payment. You can then use the documentation to delete the record to carry out a rapid rescore to have it removed. So again, this might be the boost you need with little cash on the borrowers, is to focus on those external collection company accounts. And I mention this because removing those type of accounts may move the needle enough so that you don't have to worry about having that conversation with your borrower that their rates have now changed or their fees have now changed due to what's happened in the industry for the last few days. So I hope all of you are well, safe at home. And if you ever need anything from CreditXpert, please reach out to us at info@creditexpert.com.